Negative equity destroyed a generation of homeowners in the early 1990s. It came back in a quieter form after 2008, and right now, in 2026, a specific cohort of UK buyers who purchased at peak prices between 2020 and 2022 are discovering that the property they bought with a 5 or 10% deposit is now worth less than what they owe on it. Not dramatically less in most cases, not the catastrophic 30 or 40% collapses of previous cycles, but enough that they can't remortgage onto a better rate, can't sell without bringing cash to the table, and can't move even when their personal circumstances urgently require it. In the next few minutes, I'm going to walk you through exactly how negative equity works, who the new cohort caught inside it actually is, what it means practically for their finances and their options, and how this ends. I've been tracking the UK property market for years, and negative equity is one of those concepts people assume belongs to historical crises rather than the present. The people currently inside it tend to disagree. Let's get into it. It's worth being specific about scale before anything else, because the temptation is to either dismiss this as affecting only a small fringe or to catastrophize it as the beginning of a 1990s-style collapse. Neither is accurate. The buyers in negative equity right now are not a majority of homeowners, and the overall UK housing market has not collapsed in the way previous cycles saw. But in specific property categories and specific postcodes, the combination of peak price purchases, small deposits, and subsequent valuation falls has created a pocket of genuine serious financial difficulty that is affecting a meaningful number of people who made conventionally sensible decisions and are now discovering that the specific timing and category of their purchase put them in an unusually exposed position. Before getting into who's caught and why, it's worth being precise about what negative equity actually means in practical terms, because the word gets used loosely. Negative equity exists when the outstanding balance on your mortgage exceeds the current market value of the property. If you bought a flat for £280,000 with a £14,000 deposit, taking a mortgage of £266,000, and that flat is now valued at £245,000, you are in negative equity to the tune of £21,000. You can continue living in the property. You can continue making mortgage payments. In that narrow sense, nothing is immediately broken. The problem arrives the moment you need to do anything that requires the lender to revalue the property, remortgage to a new deal, port the mortgage to a different property, or sell and use the proceeds to fund your next move. At each of those points, the negative equity position, which felt abstract while you were simply paying your mortgage, becomes a concrete financial problem with real and immediate consequences. The cohort most exposed to this right now bought at the peak of the pandemic-driven price surge, specifically between mid-2020 and late 2022. That period saw some of the sharpest short-term price growth the UK housing market had ever recorded, driven by the stamp duty holiday, the race for space as remote working changed what buyers wanted from a home, and near-zero interest rates that dramatically expanded what buyers could borrow relative to their income. Properties in certain categories, new-build flats in city centres, flats more generally, properties in commuter towns that briefly became attractive during the work-from-home peak, saw prices that were, in some cases, significantly disconnected from long-term fundamental value. Buyers who stretched to their maximum borrowing capacity to purchase in those categories with minimal deposits at peak prices are the ones now most likely to find themselves in or close to negative equity, as those same categories have underperformed the wider market in the years since. The new build flat problem deserves specific attention because it's where the negative equity exposure is most concentrated and most severe. As covered in earlier videos on this channel, new build apartment values in certain postcodes have fallen noticeably from their launch prices, in some cases by 15 to 20%, as the investor market that absorbed much of that stock has retreated and genuine owner-occupier demand has proved insufficient to sustain the prices at which those units were originally sold. A buyer who purchased a new-build flat in 2021 at a developer-inflated launch price with a help-to-buy equity loan covering 20% of the purchase and a 5% personal deposit covering the remainder of the difference may now find that the property's current market value, as assessed by a mainstream lender's valuation, sits meaningfully below the outstanding mortgage balance even before the help-to-buy loan is accounted for, compressing their actual equity position to something close to zero or below. For this specific group, the Help to Buy scheme's proportional repayment structure, also covered in an earlier video on this channel, makes the position even more complex because the government's equity loan has also grown in nominal terms alongside the property's value, and in some cases the combination of the outstanding mortgage balance and the equity loan liability exceeds the property's current market value even before any transaction costs are factored in.
The remortgage trap is where negative equity becomes most immediately painful. As covered in an earlier video on this channel, over 1 million fixed-rate deals are ending this year and next, and the standard process for remortgaging requires the lender to revalue the property. A borrower in positive equity, even modest positive equity, can access the standard range of competitive deals the market offers. A borrower whose revaluation reveals negative or near zero equity finds themselves locked out of competitive remortgaging entirely, unable to switch to a better rate with a new lender because no mainstream lender will advance a mortgage that exceeds the property's current value, and forced onto their existing lender's standard variable rate or whatever retention deal their existing lender is willing to offer, which is frequently less competitive than what's available to borrowers with healthier loan-to-value ratios. It's worth being concrete about what this difference means in cash terms. A borrower with 20% equity or above can typically access the best rate fixed products on the market. A borrower sitting at 95% or above loan-to-value, which is where negative equity or near negative equity places them, is in a pricing tier where the available rates are meaningfully higher, sometimes by a full percentage point or more, compounding a monthly payment that is already elevated by the broader rate environment. That difference, multiplied over a 2 or 5 year fixed term, represents a significant sum paid specifically because of the property's value position rather than any change in the borrower's own financial circumstances or creditworthiness. The mobility trap is the second major practical consequence. Life doesn't pause because your property is in negative equity. Jobs change location, relationships end, families grow and need more space, parents age and need support nearby. All of these ordinary life events can create a genuine need to move, and for a homeowner in negative equity, moving requires either finding a buyer willing to pay enough to clear the outstanding mortgage, which the market is currently refusing to do, or covering the shortfall from personal savings, which many of these buyers who stretch to buy in the first place simply don't have. Some lenders offer negative equity mortgage products that allow a borrower to port their existing mortgage to a new property and carry the shortfall with them. But these products are limited, carry conditions, and require the lender's consent, which is not guaranteed. The practical result is homeowners who are financially trapped in properties they may have urgent personal reasons to leave, with no clean exit available to them. For some, the most viable option in the near term is renting the property out rather than selling it, which at least generates income to cover the mortgage while they rent elsewhere. But this approach carries its own complications around mortgage consent to let, tax implications, and the management burden of becoming an accidental landlord in a regulatory environment that has become considerably more demanding, as covered extensively elsewhere on this channel. Now here's what connects the remortgage trap and the mobility trap, and why this cohort's experience is structurally different from casual reassurances that negative equity sorts itself out over time. The reassurance is based on the long-term trajectory of UK house prices, which, looking back over decades, does indeed show recovery from every previous dip. What the long-term average obscures is the specific timeline of recovery in the specific categories of property most affected, which is rarely the same as the overall market's timeline, and the specific personal circumstances of the buyers caught inside it. A couple in their early 30s who bought a one-bedroom flat in 2021 and now have a child with a second on the way cannot wait 15 years for the flat market to recover before they can afford to move into something larger. Their timeline is immediate, and the market's long-term average is of no practical use to them at all. Here's what nobody puts together properly. Negative equity in this cycle is being quietly concentrated in exactly the property categories that regulators, developers, and government schemes collectively push the most accessible and first-time buyer-focused products toward. New build flats, help to buy purchases, high loan-to-value mortgages on recently completed developments. The very mechanisms designed to help people who couldn't otherwise afford to buy have, in a specific combination of circumstances, positioned exactly those buyers in the most vulnerable part of the market, precisely the segment where values have fallen fastest from their pandemic peak. This isn't an argument against those mechanisms in principle. It's an observation that the combination of maximum leverage, minimal deposit, and a property category with specific valuation vulnerability created an outcome that was foreseeable in hindsight, and that a meaningful number of buyers are now living through. It's also worth naming the emotional dimension of this situation directly, because it's easy to focus on the mechanics and miss the human experience. Many of the buyers in this cohort saved for years to afford their deposit, navigated a competitive market, made a genuinely committed long-term decision to buy, and now find themselves in a situation that feels like they're being punished for doing exactly what they were encouraged to do. That experience of having followed all the conventional advice and still ended up in difficulty through no fault of their own conduct is one that deserves acknowledgement alongside the financial analysis.
Here's how this plays out for the buyers currently inside it who don't have a clear plan. They receive their remortgage renewal letter, discover through the revaluation that their loan-to-value ratio is worse than expected, find the competitive products they were counting on aren't available to them, and end up on a rate they can't really afford, on a property they can't sell, in a situation they can't exit without a financial shortfall they don't have. They make their payments because the alternative, mortgage default and repossession, is worse. They wait, hoping the market moves in their direction before their personal circumstances force a decision the market isn't ready to support. Here's how this plays out for buyers who approach it more actively. They don't wait for the remortgage renewal to discover their position. They get a realistic assessment of their property's current market value well in advance, either through an independent valuation or through careful analysis of comparable sold prices in their specific postcode. They contact their existing lender proactively to understand what retention products are available to them specifically given their current loan-to-value position, rather than discovering this information at the last minute under time pressure. Where the negative equity gap is modest and their financial position allows it, some make overpayments specifically to reduce the outstanding mortgage balance toward the point where a competitive refinancing becomes available. And where the situation is more severe and their personal circumstances are genuinely urgent, they seek specialist mortgage advice, rather than assuming standard channels will have a solution. Some also explore whether the lender has any formal negative equity mortgage scheme, of the kind that certain lenders have historically offered in response to previous cycles, where the shortfall can be attached to a new mortgage on a new property under specific conditions, allowing the buyer to move even if the sale doesn't fully clear the original debt. These products are not widely advertised, but for borrowers whose circumstances require them to move and who have otherwise clean credit histories and stable incomes, they represent a route that's worth actively investigating rather than assuming doesn't exist.
Here's how this plays out at the wider market level over the next 2 to 3 years. Expect the negative equity cohort to remain broadly stable in size rather than growing dramatically, because the wider UK housing market outside the specific vulnerable categories has remained resilient, which limits the spread of the problem beyond the concentrated areas where it already exists. Expect the new build flat segment to remain the most challenged on valuations for longer than other property types, given the structural oversupply issues in certain postcodes covered in an earlier video on this channel. And expect lenders to continue developing and refining negative equity mortgage products as the scale of the affected cohort becomes clearer, since there is a commercial interest in retaining and managing this book of business rather than simply leaving borrowers stranded on standard variable rates indefinitely. If you bought between 2020 and 2022 with a small deposit, particularly in a new build flat or a commuter belt property that was riding the pandemic price wave, the most useful thing you can do right now is find out precisely where you actually stand. Not where you hope you stand, not what an automated online estimate says, which uses algorithms rather than genuine market comparables for your specific block, an actual assessment based on what properties genuinely equivalent to yours are selling for in your specific postcode right now. That information either confirms you're fine, in which case you can plan normally, or it tells you the size of the gap you're working with, which is information you need, however uncomfortable it is, to make a realistic plan for your options. Negative equity is not a moral failure. It's a financial position that results from timing, leverage, and market movement, three things that interact in ways no individual buyer can fully control. Understanding your actual position is the first step to navigating it. Discovering it under time pressure, at the moment your fix ends or your personal circumstances force a decision, is the version of this story that tends to end worst.